A lot of people outside the construction world assume success in this industry is about the materials you put in the ground. Steel, wood, concrete. But if you're running a contracting business for any real amount of time, you know that's not what makes or breaks a company. What determines whether you grow or struggle in this industry is something that most people never even think about. It's your cash flow. It's the part of the business that doesn't show up on project photos, but it definitely shows up when you're staring at payroll on a Thursday night and doing the math. You can win bids, you can sign big contracts, you can have a full schedule, and still you can feel like the money never hits your account fast enough. You pay your crews on Friday, but the job doesn't pay you for weeks, sometimes months. And that gap could be exhausting and scary even. What I want to talk about today is how to finally get control of that. Because the truth is, the old funding rules contractors relied on just don't work anymore. The environment has changed, but the contractors who understand the new financial tools available to them are putting themselves in a much stronger position than any of their competitors. And I want to walk you through those tools in a simple, practical way. Let's start with where things stand right now. If you're a commercial, industrial, or residential contractor, there's a good chance that you're busy. The backlog in 2025 is strong across HVAC, electrical, plumbing, concrete, you name it. But being busy doesn't always mean you're profitable. And I'm sure if you're watching this, you know that. And it definitely doesn't mean cash flow is stable. Most of the owners I'm talking to, they say the same thing. Getting work isn't the problem. Waiting to get paid on the work is. Believe it or not, there's actually a name for that dynamic. It's what a lot of experts call a profitless boom. It's when everyone in the industry has work. Revenue looks good, but on the ground, you're constantly fighting for capital. You're caught between paying your team on time and waiting for that next progress payment to come in from the client, hopefully without delays. Let me give you a quick example. I spoke with a concrete contractor not long ago. He finished his portion of the work in 12 days, sent his invoice the next day, and he still waited 68 days to get paid on that one 12-day job. That's more than 2 months after the work was completed and inspected. But in those 2 months, payroll came every single week. He was still trying to work and buy materials and get things for new jobs. Fuel prices even went up, insurance premiums hit, material suppliers needed payment. He wasn't doing anything wrong. He was just stuck in a system that pays slow and demands fast. This is more common than you think. On paper, general contractors assume they get paid in 30 days. But the subcontractors, the people who actually perform the work, report waiting an average of 56 days to get paid on the invoices that they issue. That 26-day difference, that's where the cash pressure shows up in any growing business. That's where good companies feel the squeeze even when they're doing solid work. And when that pressure gets too tight, most owners think of one place, the bank. Historically, the bank was the solution. A line of credit, a term loan, something to bridge the timing gap. Getting funding from a traditional bank is harder than ever for construction companies, and it's only going to get harder in 2026. And it's not because contracting is a bad industry, it's because banks are cautious right now, especially anything related to renovation or construction. I recently worked with a commercial electrical contractor who applied for a $300,000 line of credit. Strong revenue, great reputation, clean books too. The bank still said no. Not because he wasn't profitable, he actually was. The bank wanted more collateral. They wanted to do a first position lien on the contractor's receivables. They wanted more guarantees and a higher coverage ratio than most contractors can realistically provide. Their standards weren't based on his business. They were based on his industry and the bank's fear of economic uncertainty. Even when banks do approve loans, the cost isn't always friendly. Commercial rates hold between 7 and 9%, and that doesn't leave a lot of room for error on projects when margins are already tight. That means every borrowed dollar has to stretch further. It's not that construction owners are mismanaging anything either. The system itself is hard to navigate. And if you don't qualify for those 7 to 9% loans, you're usually looking at much more expensive money, which makes it even harder. This is why many contractors are now turning towards tools that have always existed in the tax code but weren't widely used until recently. And one of the biggest advantages available right now is the return of 100% bonus depreciation under the One Big Beautiful Bill Act. I know the name sounds unusual, but the impact is significant and it'll really help your bottom line, so listen up. Here's what it means in plain English. If you buy qualifying equipment, whether that's an excavator, a skid steer, a dump truck, a backhoe, trenching machine, a bobcat, anything you'd consider yellow iron, you can deduct 100% of the purchase price in the same year you put it into service, even if you're financing the equipment over several years. Let's break that down with real numbers. Say you buy a $450,000 piece of equipment. You might be making monthly payments of around $7,000. But for tax purposes, you get to deduct the full $450,000 this year if you'd like to. If your business is profitable, that deduction could save you tens of thousands of dollars on taxes. That's money you can use to strengthen your cash flow, invest in more equipment, or build reserves. But you gotta make sure that you're not writing off too much in order to qualify for the best funding. So when you're talking to your bookkeeper or accountant, tell them that you wanna save money on taxes, but you also want to maximize your enterprise value. So that will give them a good balance. And when you combine this with Section 179, which lets you expense up to $2.5 million of qualifying purchases, the benefits stack up big time. This is how larger contractors grow very strategically. They don't just hold on to cash. They direct it into assets that reduce taxes and increase capacity. The tax code rewards reinvestment, and most business owners never fully take advantage of it because they just don't understand that the opportunity is available. But even with the smart tax planning, there's still the core issue. And that's the timeline of when you pay out versus when you get paid back. That's where a lot of business owners are feeling stuck. You win a $300,000 job, but before the first invoice is even processed, you might be out $30,000 to $40,000 on materials, labor, mobilization, and bonding. That upfront burden is what holds companies back from taking on more work. This is where contract financing comes into play. This sort of credit facility is designed specifically for subcontractors who need capital at the start of a project. And it works differently from traditional funding. Instead of looking at your previous tax returns or collateral, the lender looks at your signed contract and the credit worthiness of the general contractor. If the job checks out and you've got historical financials, they give you the capital you need to get mobilized and get started. Then, when progress payments come in, a portion of those payments automatically pays down the mobilization loan. That means you're not draining your reserves just to get the job moving. You're using the job itself to actually fund the job. Let me give you another quick example. A commercial drywall contractor I know won 3 mid-sized projects, all starting within a few weeks of each other. Without contract financing, he would have had to choose just one because he didn't have enough cash to float labor and materials on all 3. He had the people, he had the supply sources, he just didn't have the cash. With contract financing, he took on all 3 of them. His team stayed fully mobilized and his revenue grew without putting him in a cash bind. Now, I want to be clear about something. Contract financing is not the same as a merchant cash advance. An MCA pulls daily or weekly payments from your account, no matter what's happening on the job site. If the GC is slow approving your invoice, if weather delays your schedule, if materials are back-ordered, the MCA is still going to pull their debits, and that can create a downward spiral very quickly. Contract financing, on the other hand, moves at the rhythm of the project, not the rhythm of the lender's repayment schedule. Another tool contractors don't take advantage of enough is negotiation, specifically negotiating retainage. Retainage is usually 5 to 10% withheld until the project is fully complete. You could get more of that. And if you're honest, that retainage often represents most, if not all, of your profit on that job. It can sit there for months, even after your work is done. One of the most effective strategies I see good contractors use is negotiating zero retainage on materials. Materials are delivered, they're installed, they're documented. They're not subject to performance adjustments the way labor is. Many general contractors are open to this. They just don't get asked by their subs. Another option is using a retention bond. Instead of waiting months to get retainage released, you pay a small fee for a bond, and the GC is protected completely. It frees up your cash without increasing their risk. And don't forget supplier terms. If your customer pays you in 45 or 60 days, but you're paying net 30 to your supplier, you're creating unnecessary pressure on yourself. If you're buying $50,000 or $100,000 a year from a supplier, ask for net 45 or net 60 or even net 90, especially if you're over 2 years' time in business. You can offer to consolidate your purchasing in exchange. This single negotiation can significantly improve your cash cycle. At the end of the day, what I want you to hear is this: you're not struggling because you're doing something wrong. You're struggling because construction is set up in a way that pays slow and requires subs to finance the work up front. But there are real proven tools that can shift the dynamic in your favor. Not tricks, not loopholes, not hacks. Just smart financial strategy that fits the reality of your industry. If you want help understanding your options, whether that's funding a new project, navigating tax strategies around equipment financing, or improving your cash flow with a line of credit, there's a link below this video and you can book a conversation with my team. It's not a sales pitch. It's a working session where we look at your numbers, your payment cycle, your goals, and we help you build a cash flow and funding strategy that actually supports your business. You've worked too hard to constantly feel squeezed. You deserve clarity. Let's get you there.